Now, let me ask you a question. If your business doubled in size next year, would you automatically assume it's healthier? Most people would, really. More customers, more employees, more locations, more revenue. Surely that means you're winning and your business is doing well, right? But not necessarily does it happen in every situation. Sometimes growth is the very thing that destroys a business. In fact, some businesses don't fail because they stop growing. They fail actually because they grew faster than their cash flow could support the growth. That's today's, financial autopsy point of discussion, and it's really going to be about WeWork. But this story about WeWork isn't really just about office buildings. It's about something every founder needs to understand today and going forward, which is the difference between looking successful and actually being financially sustainable. Because those two things right there are not the same. When WeWork launched the idea, it was really a brilliant one. Businesses were changing, freelancers were increasing, startups didn't want long-term office leases. Companies wanted flexibility, they wanted modern workspace, they wanted, good ambience within the workplace, right? WeWork didn't just rent offices, it sold an entire experience to its customers. Beautiful buildings, office bars, networking events, like modern designs, literally. People loved it. Investors loved it. And even the media themselves, they loved it as well, right? So the company expanded across cities, across countries at incredible speed. Its valuation climbed into tens of billions of dollars. To many people, really, WeWork looked like the future of work. But beneath the headlines, a difficult and different story was unfolding. One of the biggest mistakes founders make is believing that fundraising is the same thing as financial strength. It isn't. Raising money gives you cash, no doubt about that, right? It doesn't automatically give you a sustainable business. The first symptom at WeWork wasn't slow growth in itself. It wasn't even lack of customers. It was a business model that required enormous amounts of cash simply to keep expanding. Growth demanded more, leases, more renovations, more staff, more marketing, more capital, right? The company wasn't just growing, it was consuming cash at an extraordinary and alarming rate, right? And that's really where the warning signs began to show. I would like to analyze this in 5 stages, as I always like to do, right? So the first stage is what I call expansion becomes the strategy. Growth is exciting, no doubt about that, right? So new locations, you have new announcements, you have new headlines, right, from that growth, right? But growth should be the result of a healthy business model. It should never, become the business model in itself. Every new location required significant investment for WeWork long before it even generated meaningful cash inflow into the business. Just think about, for example, your own business. Imagine opening 5 new branches, before the first one consistently produced sufficient cash flow back, right? And when I say consistent cash flow, I mean healthy cash flow that exceeds the outflow from the business, right? Now, growth starts creating pressure instead of strength when your outflow is higher than the inflow of cash coming into your business. The second stage is what I like to call cash burn accelerates, right? Let's simplify this. Imagine your business generates, say, $1 million every month. It sounds impressive, right? Yeah. But, imagine you are spending $1.3 million every month as well. You're losing $300,000 already every month. Now imagine an investor keeps replacing that money for you, that difference of $300,000 every month with funds you raise, right? From the outside, everything really looks good. The lights are on, the team grows, the announcements continue, right? But underneath, the business has become dependent on external funding to survive, what we call equity financing, right? And that's not healthy cash flow. That's borrowed time, and the clock is really ticking for the business. The third stage is what I like to call valuation hides reality. This is very critical for founders. And this is where many founders become confused. A high valuation doesn't pay suppliers, it doesn't pay salaries, neither does it pay taxes to the government, it doesn't even pay rent in itself. What pays all of this is cash, and cash is the lifeblood of a business. The media celebrated the valuation, true. Treasury would have instead been asking a different question at that point. And that question is, how long can this business survive without another funding round? Those are very different conversations in themselves, right? The fourth stage is what I like to call confidence changes. Businesses don't operate in isolation. We all know that, right? Investors have confidence. Employees have confidence. Customers themselves have confidence. Lenders have confidence, right? When confidence is high, capital flows into a business easily, right? But when confidence, weakens, everything changes for the business. As questions emerged about governance, for WeWork profitability, sustainability and investor, concerns began to rise, confidence then began to decline for WeWork. Now, the same business that had once, attracted investors and enormous funding suddenly faced much tougher scrutiny, right? The cash that fueled its rapid expansion was no longer guaranteed. And that's where the financial pressure for WeWork became visible. Now, the fifth and final stage is what I like to call reality arrives. Here, eventually, WeWork then was forced to dramatically reduce its cost, restructure operations, and rethink its entire business strategy. The business survived, but only after painful changes were implemented. And the collapse wasn't caused by 1 month alone. It was a result of years of prioritizing rapid expansion, without building sufficiently resilient financial practices. Many people think WeWork almost failed because investors stopped believing. I think investors stopped believing because the underlying economics became impossible to ignore, right? Growth is wonderful, don't get me wrong, right? But growth without sustainable cash generation, right, eventually will demand difficult questions from those people who fund you, whether they're investors through equity financing or financial institutions like banks through debt financing, right? Every business reaches the point where someone asks, can this business support itself, right? That's the question every founder should ask long before investors ask them, right? Now, as a certified treasury professional, if I were leading treasury at a rapidly growing business like WeWork, these are the questions that will be keeping me awake at night, right? The first is, how many months of cash runway do we actually have, right? The second will be, how quickly are we burning cash in the business? And now the third I'll ask is, how dependent are we on external funding? And the fourth is, if funding stopped tomorrow for us as a business, how long could we continue to operate the business? Then I'll also ask, how much of our growth is funded by internally generated cash, right? So cash generated from the operations of the business. And then the final one I ask is, are we scaling a profitable engine, or are we just simply scaling expenses as a business? Treasury isn't against growth in itself. Treasury protects the business while it grows. And that's a very important difference to understand right there. One of the most important principles behind the cash flow prioritization matrix is this: growth should strengthen resilience in itself. It should not increase fragility. Every dollar invested in expansion competes with other important priorities like liquidity, so maintaining sufficient liquidity within the business, or risk management, mitigating all of the risks that the business is prone to, right? Working capital, optimization or utilization, right? Technology, operational resilience, and all other competing priorities that businesses have to execute to achieve its objectives. If every available dollar is directed towards growth, while the business becomes financially weaker underneath, right, then growth is creating a hidden risk for the business instead of building long-term value, right? Now, the objective isn't to grow as fast as possible. The objective right there is to grow at a pace that your cash flow can sustain. Very critical here. Now, let's do one simple calculation to give more context to all that I've said today, right? Now, calculate your monthly cash burn. Take all the cash leaving your business each month and subtract the cash coming into your business. If you are spending, say, $250,000, each month, and you are bringing in $200,000, as a monthly cash inflow into your business, it means that your cash burn is actually 50,000, right? So simply 250 outflow minus your 200,000 inflow, right? Now calculate your runway. If you have, say, $600,000 available in cash, your runway would therefore be that $600,000 divided by the $50,000 difference we calculated earlier. This basically means that you have 12 months before cash runs out, right? Assuming nothing else changes. So assuming you don't receive any extraordinary inflow, into your business. Now, at this point, I want you to ask yourself one critical question. If no investor gave you another dollar or another amount, just, related to your own currency, would your business survive in the next, say, 6 months or 1 year, 3 years, 5 years, 10 years? Now, if the answer to that question is no, your next priority shouldn't be faster growth. It should be building a business that can eventually fund its own future. One thing I want you to take away from today is that WeWork didn't almost, collapse because growth is dangerous in itself. It's not. It almost collapsed because growth without financial discipline eventually exposes every weakness in a business model. Growth magnifies whatever already exists. If your financial, say, foundation is strong, for example, growth creates opportunities for your business. But if your financial, say, foundation is weak, it means that growth accelerates that weakness. It accelerates the problem for your business. Make sure that you never confuse valuation with value. Critical. Never confuse valuation with value. So critical, I had to repeat myself again, right? And never confuse growth with financial health, because the healthiest businesses aren't always the fastest growing ones. They are the ones, that can still grow tomorrow. Now, another question I have for you today regarding WeWork is to say, or let's think about this. At what stage do you think that WeWork could still have changed its financial trajectory? I'd love to hear your perspective in the comments, right? Now, before, you make your next major growth decision, I want you to ask yourself these key questions right here. The first one is, if outside funding stopped tomorrow, how much or how many months, I would say, could my business continue operating? Then also ask, is my business generating enough cash to support its own growth? Or am I relying only or majorly on external funding to bridge that gap? Also ask yourself, are we measuring revenue growth more closely than cash flow quality itself, or even our ability to convert revenue to cash flow, assuming you sell on credit, right? Then ask yourself, which expansion projects are strengthening the business and which ones are simply increasing our fixed commitments or fixed expenses that we have to pay out, right? Then ask yourself, finally, if my business doubled in size, say next, year, would my cash flow in itself become stronger, or will it even become more fragile? Because thinking about this, the goal really isn't to build fastest growing businesses in your industry. The goal is to build one that is still standing even 10, 20, 100 years from now, right? Onto the fourth generation, right? So, and really, thinking about it, it all begins with understanding the cash flow is not growth in itself, right? It is really what keeps the business alive. Very critical here. Now, if you liked all that you heard today, I want you to subscribe and like this video, as I'll be doing more analysis of big names that used to exist before but have filed for bankruptcy, so that you can take that lesson, apply it into your business, and we can grow sustainable businesses together. So subscribe, and I'll see you in the next video.